Let's jump right in. Welcome back to another Explainer, where today we are exploring a corner of the financial universe that is honestly just as thrilling as it is dangerous. We're talking about trading crypto futures. Look, if you've ever wondered how some traders seem to pull massive gains overnight in the crypto market, or on the flip side, wipe out their entire portfolios in the literal blink of an eye, well, you're in exactly the right place. We're going to decode the actual mechanics behind these incredibly powerful financial instruments.
To really set the stage here, think of this market as the ultimate double-edged sword. As the saying goes, this form of trading offers the possibility of high returns, but it also comes with significant risks. That right there, that's the core motif we need to keep in our heads today. Because the allure of life-changing profits is, well, it's incredibly strong, right? But the danger of amplified losses is literally always lurking just beneath the surface. It is not a game of luck, it's a game of calculated risk.
Don't let the complexity intimidate you. Today, we'll cover 1. What are crypto futures? 2. Mechanics of futures trading. 3. Choosing the right exchange. 4. Top crypto exchange platforms. And 5. Strategy and risk management. We're going to navigate this whole landscape step by step.
Starting with Section 1. What are crypto futures? Before jumping into the deep end of crazy leverage and wild price swings, we absolutely need to build a rock-solid foundation.
Okay, so at its core, a futures contract is a financial agreement allowing traders to speculate on the price of a cryptocurrency at a specific future date and a predetermined price, entirely without actually owning the asset. I really want to emphasize that last part. This fundamentally differs from traditional spot trading. In spot trading, you're buying the actual Bitcoin or Ethereum and securing it yourself. But in the futures market, you're purely speculating on the price movement. You get the financial exposure without the logistical hassle of securing or storing the underlying digital asset.
Section 2. Mechanics of futures trading. Okay, let's dive into this. Now that we know what they are conceptually, we really need to understand the actual moving parts of a trade.
Now, what's truly wild about this dynamic is the massive appeal of ultimate flexibility. You can take a long position, which just means you're betting the asset's price is going to rise. Or you can take a short position, betting the asset's price is going to fall. Unlike standard spot investing, where you only make a profit if the chart goes up, in futures, you can make money whether the market is rocketing straight to the moon in a bull run or crashing violently down to earth in a bear market.
But you might be wondering, how do these traders make so much money off of tiny fractional price movements? Well, the answer is 125x. That is the maximum leverage offered on some major crypto platforms, and it is a staggering number. Leverage basically means you can borrow capital from the exchange to control a massive position with a tiny initial investment. So if you put down just $100, 125x leverage allows you to control $12,500 worth of crypto.
But, and this is a massive, massive but here, leverage amplifies both potential profits and potential losses. I literally cannot stress this enough. While leverage maximizes your potential gains on a winning trade, it equally and brutally multiplies your risk on a losing trade. With high leverage, a market move of just a fraction of a percent in the wrong direction could instantly destroy your entire initial deposit. Which brings us to perhaps the scariest two words in all of trading: the margin call. So a margin call is a strict requirement to maintain a minimum account balance to cover any potential losses. Because remember, you're playing with borrowed money via leverage. If the market moves against your position, the exchange is going to demand that you add more funds to your account. And if you fail to do so, the exchange forcefully closes your position to prevent further loss. You get liquidated. You lose everything in that trade. Game over. Section 3. Choosing the right exchange. Now that we understand the core mechanics and the very real risks involved, a super practical question pops up. Where should you actually apply these new concepts? Let's figure that out.
If you're going to trade futures, mastering these essential exchange features is completely non-negotiable for protecting your profits. You absolutely need low trading fees, otherwise the costs of opening and closing leveraged positions will just eat you alive. You need ironclad security. We're talking two-factor authentication and cold storage to keep hackers out. You need high liquidity, so your fast trades actually execute instantly at the price you want. And you need advanced technical tools for charting. Now, while platforms like XNES or MEXC offer some really great tools for altcoins, these core factors must be your baseline checklist before trusting any exchange with your money.
Section 4. Top crypto exchange platforms. With those strict criteria in mind, let's introduce the heavyweights of the crypto exchange world and compare their specific offerings.
And this brilliantly illustrates how the major players stack up. Look at Binance. It holds a massive 4.6 rating, offering that crazy 125x leverage we just talked about, alongside really deep liquidity and a vast crypto selection. KuCoin, sitting at a 4.3 rating, limits leverage to 100x but totally shines with a huge selection of alternative coins if you want to trade more niche assets. Then we have Bybit, with a 4.5 rating, which also offers 100x leverage, but really focuses on advanced pro tools, lightning-fast execution, and insurance protection. Comparing these metrics is a fantastic way to pick a platform based on whether you're, say, an active pro seeking deep liquidity or an absolute beginner looking for specific altcoin markets.
And speaking of your experience level, if you are just starting out, you absolutely need to heed this advice. Beginners should look for simplified interfaces, lower leverage options, and extensive educational resources. You really should stick to beginner-friendly environments like Binance or KuCoin while you're learning the ropes. They offer intuitive designs that make it easy to monitor positions, rather than, diving headfirst into complex platforms meant for professional Wall Street veterans.
Section 5. Strategy and Risk Management. This perfectly sets up our final and, frankly, our most vital chapter today. This is where we bring it all together and equip you with a protective shield for your capital.
Let's walk through this playbook step by step. Step 1. Practice with demo accounts. Seriously, do not use real money until you prove you can be profitable with simulated money. Step 2. Use technical analysis to identify actual market trends rather than just guessing. Step 3, and honestly, this is the holy grail of trading, set stop-loss and take-profit levels. A stop-loss automatically sells your position before a catastrophic margin call can hit you. It caps your downside. And Step 4, diversify and use smaller leverage. Just because 125x is available doesn't mean you should ever use it. Keep your leverage low, protect your capital, and never ever risk more than you can afford to lose.
So we arrive at our final stage, and a deeply provocative question you really must ask yourself. Are the immense potential returns of futures worth the amplified risks to your capital? The crypto futures market offers incredible opportunities to profit in both rising and falling markets, for sure. But as we've clearly seen today, it demands continuous learning, an ironclad discipline, and top-tier risk management. The tools and platforms are out there, but the emotional control and strategic discipline, that is to come from you. Thank you for joining me for this explainer. I really hope it gave you some incredible clarity today. Until next time, stay focused and keep learning.